Welcome back. This is part three of the capital structure puzzle. Today I'm going to talk about pecking order theory. In previous videos, I've talked about static trade-off and the main result and research question that underlies this paper by Myers. So, as a brief reminder, pecking order theory is essentially the preference of internal funds over external funds. That means any cash generated internally, any funds are preferred to uh, than external when maybe investing in a project. And when you absolutely must generate external funds, you prefer debt to equity as a firm. So this observation has actually been made already in 1961. It's quite an old one. Donaldson made a study in 1961, and he said management strongly favored internal generation of funds as a source of new funds, even to the exclusion of external funds, except for occasional unavoidable bulges in the need for funds. Wow, funds happen a lot of times in this code. These bulges were not generally met by cutting dividends. Reducing the customary cash dividend payments was unthinkable to most managers, except for as a defensive measure in a period of extreme financial distress. So, indeed, this is a fairly old idea. Pecking order theory, however, is rejected when we require it to explain everything about capital structure. It's very neat, as we saw, in explaining how funds are raised, but it's not very good at explaining anything else. Like, how and why is pecking theory observed? Like, why does it actually happen? There is not much theory. At least in the distant year of 1984, there wasn't much theory as to actually why that happens. So this is the third problem which Myers discusses in his theory. Like, theory doesn't fully explain capital structure, nor is it very well explained as why it works. I mean, there's also plenty of examples in which firms issue stocks instead of issuing investment grade debt. Well, what Myers thinks is going on, Myers and Majluf actually, in this simultaneously released paper shortly after the paper I'm discussing in this video, they think informational asymmetries are happening. So what he says, informational asymmetries can help to complete this pecking order theory. Now, why? Why is this pecking order theory observed in the first place? Well, writers on managerial capitalism have interpreted the firm's reliance on internal finance as a byproduct of the separation of ownership and control. Professional managers avoid relying on external financing because it would subject them to the discipline of the capital market. This means paying back interest, or in the case of shareholders, paying dividends. So it makes so that a lot of the cash flow is reduced every time a manager must make the payments. And cash flows are great for managers because managers can use these cash flows however they want, invest them in a project, increase the resources at their disposal. They really like to have this money to spend. This is the classic principal agent problem, and when framed in a corporate finance term, we may refer to this as the owner manager problem, in which differences in formation and control over different firm profits can lead to the creation of costs. For instance, imagine the owners, so shareholders of a company, expect dividend payments at least every financial quarter. In order to deliver these payments, the manager must have made enough free cash flow, so that is internally generated cash available for investing in projects, etc., etc. And so now imagine that this manager sees an amazing project and her opportunity, which will expire this is an opportunity which will expire just before the dividend payment, theoretically speaking. And that this this project requires the same amount of cash to be invested as you need to pay back in the dividend payout. In other words, there is no way to pay both dividends and invest in the project. In this case, missing out on such an opportunity would be bad. So, or the shareholders not receiving their dividend can also be considered bad. This is what an agency cost is essentially. These are costs which arise because of this separation between ownership and control. Indeed, the rise of these costs is due to the separation of ownership and control. It is the birthplace of the principal agent problem. This is a major contribution of the paper, or at least the personal one for Myers and Majluf, because they expose what went on to soon be published in their 1984 paper, which mysteriously and sneakily came out very soon after this paper. So now brace yourself, because I'm going to discuss exactly their contribution, that is the external financing with asymmetric information. So this is sort of an explanation for this pecking order theory, which uses asymmetric information, these agency costs, in explaining why firms prefer to use internal funds and why they prefer debt to equity. All right, so perhaps it's best if you follow on with pen and paper so you know exactly what's going on. All right, suppose the firm has to raise N dollars in order to undertake some potentially valuable investment opportunity. Let Y denote this opportunity's net present value, and let X be what the firm will be worth if the opportunity has passed by. The firm's manager knows what X and Y are, but the investors in capital markets do not. They only see a joint distribution of possible values. All right. So the benefit of raising N dollars by a security issue is Y, and the net present value of this is the net present value of this investment opportunity. There is, however, a possible cost. The firm may have to sell securities or shares for less than what they're really worth. Suppose the firm issues stock with an aggregate market value, and when issued, this value is N. However, the manager knows that these shares are actually worth N prime. In the paper, they denote this as N sub 1, subscript 1, but I denote to it as N prime in these slides because I didn't know how to make an N sub 1. All right, moving on. So again, this N prime is what the new shares will really be worth, all things held equal, when investors acquire this manager's special knowledge. So Majluf and Myers discuss several possible objectives for managers that they may pursue when they would be in this situation. What they think actually makes the most sense is that these managers are maximizing the true or intrinsic value of the firm's existing shares. That is, the manager worries about the value of old shareholders' stake in the firm. Investors know the stock issue. Investors know that the manager will do this. In particular, the new investors who purchase any stock issue will assume that the manager is not on their side, and they will rationally adjust the price they are willing to pay for a share. Now, define this delta N, as the amount by which shares are over or undervalued. So you can imagine delta N being N1 minus N. The manager will issue and invest when the net present value of the project is greater than or equal to the delta N. So the amount by which shares are over or undervalued. And this makes sense. If the manager's inside information is unfavorable, apologies, delta N is negative, and the firm will always issue, even if the only good use for these funds raised is to put them in a bank. That would be a zero net present value investment. If the inside information is favorable, however, the firm may pass up a positive net present value opportunity rather than issue undervalued shares. But if management acts this way, its decision to issue will signal bad news to both old and new shareholders. In this case, let V be equal to the market value of the firm. So the price times shares, price of the shares times the number of shares it does not issue. So the V is the market value of the firm. It does not when it does not issue. V prime, on the other hand, is the market value if it does issue shares. V prime includes the value of the newly issued shares, of course. Um, Now, if everyone knows that the manager will act according to the inequality above, so the net present value greater than or equal to the the value by which shares are overly or undervalued, then the conditions for rational expectations equilibriums are the following. And you can see how the value of a firm when a firm does not issue shares, so the distribution x tilde conditional on no issue is equal to the expectation of x tilde conditional on y smaller than less than delta n, and the bottom you can read yourself, but this is quite intuitive. It makes a lot of sense. So the total dollar amount raised by the firm is fixed by assumption, but the number of new shares needed to raise this amount is not. Thus, a delta n is endogenous because it depends on V prime. For example, however, if the firm issues, the fraction of all shares held by new stockholders is n over V prime. The manager sees the true value of their claim as n1, n prime in my previous slides, equals to n over v prime times the quantity of x plus y plus n. Thus, given n, x, and y, and given the stock that is issued, the greater price per share, the less the value is going to is given up to new shareholders, and the less delta n is. So, what are the implications of this? There's two core points we can take from this. Wrong slide. Okay, let's just stay on this side. First core point, the cost of relying on external financing is usually thought of as administrative, and in some cases, mispricing securities. Asymmetric information costs make it so firms choose to not issue and pass up positive net present value investment. This cost is avoided if the firm internally finances enough. This means it is the cost of relying on external financing which makes firms prefer internally financing their investments. Second point, the advantage of debt over equity. If a firm seeks external funds, it is better off issuing debt than equity. This is in cases that management has favorable information. The whole idea is that pecking order theory can be explained through informational asymmetry. So research in this area is likely to progress the question of optimal capital structure. This is the main contribution of the paper. This is where Myers sort of says, hey, look, guys, we don't think, so Majluf and Myers say, we don't think that static trade-off theory is going anywhere as it is. Maybe if we included some other things. What we think is going on is that pecking order theory can be developed more through asymmetric information, and maybe one day we can even explain capital structure. Stay tuned for the next video in which I'm going to talk about 5 facts and 3 observations, additional observations, which Myers makes in this paper, and I'm going to talk about the contribution this paper makes.